Other than the UK government, King Charles the Monarch is the largest individual landowner in Britain, with an estate worth over £20 billion. He owns over 700,000 acres of land, more than half of Britain's shoreline, and virtually all of its seabed. But it doesn't end there. The Monarch's portfolio includes 6 of the 10 most expensive homes in the UK, ranging from grand estates to business parks, small rented cottages, and historic landmarks like the Tower of London, which itself is valued at around £880 million. Yet it's not just the monarch who understands the immense value and influence of owning vast amounts of land and property. A recent survey by Investec Bank found that 77% of individuals earning over £500,000 a year are looking to increase their UK property investments right now. In response, Investec themselves has launched a UK real estate equity investment strategy aiming to raise £250 million to acquire properties over the next 2 years alone. And they are not alone. Over £4.5 billion was invested in the build-to-rent sector last year alone, primarily by large private equity firms. Year after year, this sector is breaking records and attracting even more investment. So what's going on here? Because while headlines often claim the buy-to-let market is dying and landlords are fleeing the sector, beneath the surface, the ultra-wealthy and massive private equity firms are pouring billions into gaining market share in UK property. Let's explore why the rich are targeting UK property and, more importantly, how they're doing it, so you and I can consider similar strategies. But before we get into it, if you don't already know me, I'm Will Gale, and I've spent since 2012 building a UK-wide home buying company, British Home Buyers, a nationwide estate agency, British Home Sellers. So my whole background is really all about property, which is why I hope my insight may be useful to you. So anyway, let's get into it. Why are the rich targeting UK property? So the first thing is currency exchange rates. As the pound weakens and has weakened against the dollar and the euro, UK assets like property become more affordable for foreign investors. For those spending dollars or euros, that money stretches further against stuff you buy in pounds, creating a strong incentive to invest in British assets with British pounds. The ongoing fluctuations in exchange rates not only attract foreign investors, but also create opportunities for significant returns when these assets appreciate in value or when the pound strengthens in the future. It's sort of like a classic buy low, sell high scenario that savvy investors can't resist. The next thing is uncertainty in global markets. With factors like the war in Ukraine, high interest rates and unpredictable tax changes, investors, both small and large, seek stability, and property is known for its tangible and enduring value. It remains a reliable low-risk investment. In a world where stocks can plummet overnight and bonds may not always keep pace with inflation, property investments offer a haven. Additionally, the UK's legal and financial system provides a level of security that obviously attracts global investors. For example, property ownership laws are transparent here, and the UK's status as a global financial hub ensures that, obviously investors feel confident parking their capital here. The next is predictable returns. So despite the negative headlines, UK property continues to deliver competitive returns. For instance, London rental yields outperform most of Europe. The UK's average rental yield sits above 7%, and for London it sits just below 6%. And of course, historically, house prices have risen over time, providing both steady rental income and capital appreciation. Moreover, the combination of rental income and long-term capital growth makes property a dual benefit investment. While some asset classes, for instance, may offer high returns, few provide consistent cash flow and appreciation in the way that property does. The next is higher barriers to entry. So new regulations like the 5% stamp duty surcharge, Section 24 tax changes, the tenant fee ban, high interest rates, and Labour's Renters' Rights Bill have made being a landlord more capital intensive and more challenging. However, these same barriers are driving smaller landlords out of the market, creating opportunities for larger investors to dominate. For instance, institutional investors can absorb those higher costs more efficiently than individual landlords. They can often negotiate better financing terms and leverage economies of scale to maintain their profitability, even in a more regulated environment. So let's look at how the rich are targeting UK property. The strategy is simple: economies of scale. Historically, the buy-to-let market was dominated by loads of small landlords, but now large corporations and private equity firms are modernising the market with industrial scale investments. Instead of buying individual properties, many focus on build to rent projects, for instance. So building entire apartment blocks designed specifically for renting, and then centralising property management for efficiency. And then, of course, offering a professionalised renting experience for tenants. This approach reduces costs and, of course, increases returns, making it very attractive to institutional investors right now. So, for instance, companies like Lloyds Bank, John Lewis, and even US giants like Goldman Sachs are pouring billions into the UK property market to capitalise on these opportunities right now. And additionally, large investors are tapping into emerging technologies to streamline property management, from AI-driven tenant screening to smart home systems that reduce energy costs. These innovations help maximize profitability while appealing to those more tax-savvy tenants out there. But a big thing is the rise of build-to-rent in particular, because in particular, the build-to-rent sector is transforming the rental landscape right now by constructing purpose-built rental communities. Helps investors achieve significant cost efficiencies and at the same time enhances the tenant experience. Build-to-rent properties often include amenities like gyms, co-working spaces and communal lounges, which not only justify, higher rents, but also attract longer-term tenants. And build-to-rent developments are particularly popular in urban areas where housing demand is high. So cities like Manchester, Birmingham and Leeds have seen a huge surge in build-to-rent projects, providing modern housing solutions for young professionals and families alike. So how can you and I compete with these large corporations that dominate with scale? Well, small investors can succeed by playing a different game. Don't try and be Starbucks. Try to be a trendy local coffee shop. So focus on day-to-day properties in local communities rather than large-scale developments. Offer niche, trendy, and personalized rental properties that appeal to specific tenant demographics, and build a portfolio of high-quality buy-to-let properties in areas with strong rental yields and growth potential. For example, compare rental yields in London versus cities like Leeds, where opportunities for higher returns are more evident. By targeting those sorts of areas and providing a tailored service, you can carve a niche out for yourself and become successful in property. Another strategy is to specialize in underserved markets, such as student housing or co-living spaces or short-term rentals for business travelers, because these niches often have less competition and higher profit margins. The big players can't operate at scale in those areas. So what's the future of UK property investment? As the property market evolves, staying informed and adaptable is key. The ongoing shift towards institutional investment doesn't mean the end for smaller landlords. It simply requires a change in approach. By focusing on niche opportunities, leveraging technology and prioritizing tenant satisfaction, us individual investors can thrive alongside the big players. Moreover, the UK's growing population and limited housing supply ensure that demand for rental properties will always remain strong. Whether you're a seasoned investor or just starting out, now is always the time to explore the opportunities in UK property. Anyway, what do you think of this analysis? Have I missed anything? Let me know in the comments below. And of course, don't forget to like and subscribe for more insights into the property market. I'll see you up here in the next video.